All right, guys, we've got another edition of the Blueprint here, and a pretty special one today, quite different than before. I'm not conducting the interview today. I was on a great podcast with a buddy of mine, James Catledge, and I want to play that for you guys because we spoke a lot about mortgage, about qualifying for mortgages, but then very interesting, the entire podcast about halfway through went into mindset. And I already know that it resonated with a lot of people. The people that were filming us were behind the scenes. They came up afterward and said, gosh, this was so helpful for us. So I wanted to air it on the Blueprint for you guys today. Have a listen, and I'd love to hear from you and let you know what you thought.
In life, there's a blueprint for everything. There's no need to start over. Hear from industry leaders, those at the top of their fitness journey, and real estate gurus. They tell you exactly how they did it. All you have to do is listen, learn, and execute. This is The Blueprint with Brad Rice.
Welcome to another episode of Free at Last. We've got a special guest in the house today. He's flown in from Simi Valley, California. My friend, Brad Rice.
Yeah,
welcome, Brad.
Awesome, buddy.
Glad to have you here.
Well, thanks for inviting me.
As you know, we only bring folks onto this set to discuss financial independence. They do it lots of different ways. We've talked to folks in the jewelry business. We've talked to folks in the gold business, Dubai real estate. Today, we're talking about mortgages in this unique space where we borrow money from a third party to invest in homes and all sorts of different real estate options. And so we're going to get into mortgages today. Brad Rice is my expert in this space. He is financial independent and has been for a long time. Brad, questions that I know I get asked all the time, but you're the authority on the subject. What is a mortgage? Break it down for us. Who are we borrowing the money from? How do I qualify for one? And what is it?
Well, first of all, thanks again for having me.
Sure.
Secondly, I love that you're asking just the basic question, what is a mortgage?
Right.
So a mortgage is a lien.
Okay.
You can consider it a loan.
Okay.
That is secured by what we call real property. And
Okay.
real property is defined as property, land.
Okay.
We call that real property. Whether it has a home on it or some other structure, that's real property. On real property, there can be what's called a deed.
Okay.
And the deed is what ties the note, the loan itself,
Okay.
to the property itself. So
Got it.
there's a deed of trust and a note. They create a loan that's called a mortgage.
Okay.
Now that mortgage can have many different structures or many different types of loans, but in general, it is a loan from an institution generally, but it can be from an individual as well, that provides the balance of financing that helps somebody to acquire property, and you pay back that mortgage over some period of time plus interest, a rate of
Okay.
return for that investor.
Got it. So this is what, when we talk about the American dream, home ownership, that's what the American dream used to be, is owning your own home. This is made possible through the mortgage instrument.
That's right.
Yeah, right.
That's right.
Because most people don't make enough money to buy $1 million house. They're
And
gonna
those
need a
that do,
mortgage.
that want to, that there are people that can afford to pay all cash, but choose not to because it may not be the right leverage, and they're better off parking their money somewhere else and letting that work for them. So mortgages are used even by people who are very wealthy.
Okay, that's true. And would you consider that constructive debt, useful debt, smart debt, the proper way to use debt? And are you thinking? I just want to talk about this for a minute because a lot of people say, "Oh, I'm debt free. There's going to be no debt in my life. I just won't have any." Well, this would be a constructive use of debt, right? Where we take. I just want to kind of simplify it a little bit. Where if my interest rate is 7% on the borrowed money, the mortgage rate is 7%. If I can make more than 7% on my money, then it's better to borrow the money at 7 and go earn 10 with my money.
Yeah, that's a pretty simplistic approach to it, but there are other factors, but that is true. So if you can take your money leverage that, put it somewhere else. Maybe it's even investing in your business where you can do
Right.
a multiple return, right? And use the money on the house itself through a mortgage as an instrument where you pay it back over time. Even though you're paying interest on that, if you can use that leverage and that delta to make money, then why wouldn't you do that?
Right.
So a lot of wealthy people do that. I do want to take a half a step back
Sure,
though, because
sure.
I want to understand a comment that you said. You
Yeah.
said, used to be
Yeah.
the American dream.
Yeah.
Used to be.
Yeah.
I want to understand where that comes from, because in my world,
Yeah.
it's still the American dream.
Yeah, I think things have shifted. That's my view, and it's that view's been enhanced by the people I've met with, the people I've interviewed on this podcast. I think there are a lot of wealthy people who tune into this show who actually rent, and they rent penthouses in multiple cities. They rent beautiful beach homes in multiple locations, and they think the home ownership idea is really a bygone thought, and that home ownership strategically, perhaps where you're going to spend most of your time, may be a good idea. But we're even seeing the Grant Cardones of the world and the Ryan Pinedas of the world talking about maybe moving away from this space.
Yeah. So look, I can totally understand it from that point of view. And there are some wealthy people that prefer to completely leverage their money and not invest it in property and have
Yeah.
mortgage and debt and so forth. I get that. But truly, for most people,
Yeah.
buying a home is the American dream. And what's happened over the years that's become very unfortunate is become unaffordable. And so if we just look at history,
Yeah.
it used to be that you could buy a home in your early 20s.
Yeah.
Right? That was like the average first-time
Well,
buyer.
that's when I
They'd
bought my
be
first home.
Around 20, 24, 25 years old.
Exactly.
Do you know what it is today?
No.
40 years old.
40 years of
The
age.
average first-time home buyer,
Oh,
40
wow.
years old.
What do you attribute that to?
It's things have become unaffordable. So
Gi-
it's a
me the
combination of
reasons.
things.
Give me the reasons.
So it's a combination of things. So it is current interest rate environment.
Okay.
Okay. Which we're definitely better than what we've been in the last couple of years.
Sure.
Okay. But still, based on the appreciation and property values have gone up so much in that period of time, attributed to a lack of inventory that's out there. So this all really started back in 2008, 2007, 8, 9.
Yeah.
Where there was a lot of construction happening previous to that. The big crash came,
Yes.
and housing starts completely stopped. And I'll
Right.
explain what that means. So housing starts are the reports from home builders, so national home builders. They report the permits that they're getting when they're planning to build and construct homes and all that. And so there's a report that can be viewed that shows what housing starts are. How many builders are building homes?
New
What's
inventory
expected?
coming online.
And that has dropped off dramatically and never recovered from those years. So if you look at current housing starts and you see those reports, we have 8 years before there's enough inventory to fill the need for who the buyers are.
The 20 and 30-year-olds.
The younger buyers,
Yeah.
right? But currently, they keep postponing that because the affordability factor. So home prices are elevated. Today's market is a good example of that.
Yeah.
There's not a lot of homes for sale. They're coming down. The local market here in Las Vegas, right?
Yes.
We see this happening. We see property values declining.
Yes.
You're seeing them come down 2%, 5%,
Yes.
as much as 10%.
And that's happening across the country.
And they're not selling. Well, why aren't they selling, right? That's the question.
Because people are willing to rent right now.
They're willing to rent because
Yeah.
it's more affordable to rent
Yes.
than it is to buy.
That's right.
And so the American dream is getting extended out further and further.
Right. And there's several other factors as I look at it. Obviously, the mortgage is a big piece of it. It's probably 80% of the reason. The mortgage rate, the mortgage amount tied to a more expensive home, and then there's taxes. Then we've got taxes on there.
Yeah.
And then if you don't have 20% equity in the home with your down payment, there's this other line item inside the mortgage payment, which is insurance.
That's right.
On a failure to pay.
Yeah.
So there's all of these additional factors that literally make rent 20 to 25% lower than owning the very same home.
Spot on. You're spot on with that.
Yeah.
So you asked me what a mortgage is, but let's talk about what a mortgage payment is.
Yes.
Because somebody that's renting right now, they've never bought before, they may not completely understand
There's
what
a
a mortgage
lot of people in
payment is.
that category.
Right. And so what is a mortgage payment?
Yeah, right.
A mortgage payment consists of the principal and interest of that mortgage. Now, there are interest-only loans. It would be just interest. You're not required to pay principal.
Let's get to that in a minute. We'll cover the different types of mortgages, but just generally a mortgage.
Okay. Principal and interest payment is for the mortgage. And then you need to take into account the taxes and the insurance as well. We call this principal and interest, taxes, and insurance, PITI.
Yeah.
Okay? Those are the 4 factors that go into your mortgage payment. PITI, principal, interest, taxes, and insurance,
Yeah.
includes your homeowner's insurance, which is your fire insurance,
Sure,
right?
sure.
Fire happens,
Flood,
what covers you?
place burns
Flood may
down.
be different
Yeah.
insurance, but if
Yeah.
you're in a flood area, that could be required. That's in
Yeah.
the category of insurance. There's another layer of insurance that sometimes you have to pay called mortgage insurance. Now, people may think that mortgage insurance is like protection for them. If they stop making the mortgage payment, it's
Yeah.
going to pay the... That's not what it is. This is protection for the lender when you put less than 20% down.
Yeah.
There are ways to get around it. We'll get into that. So PITI, principal, interest, taxes, and insurance, that's your total payment. When we look at all of that, then your comment of 25% less
Yes.
on average
To
for
rent.
rent, that's where we get... So the insurance part itself
Yeah.
is a big factor. Insurance is broken. We're talking about homeowners insurance,
Yes.
general insurance. It is broken. There's not enough carriers. There's been so much regulation on these companies that they had to exit markets and increase prices to cover the regulatory requirements that they have to go through, let alone the losses they pay
The
out.
disasters,
Right.
yeah. The fire disaster in California, the flooding, the hurricanes, the storms. Yeah, it's crazy. So let's talk about the different types of mortgages. These are the ones I know. Please enhance, embellish what I know. So we've got a 15-year mortgage. We've got a 30-year mortgage. We've got a fixed rate mortgage, which could be tied to 15 or 30 years.
Yep.
And then we've got an adjustable rate mortgage or an ARM.
Yeah.
Those are the ones I'm familiar with. Is there a different type of mortgage?
Yeah, I think that those are generally it, but there are hybrids of all that. So when we're talking about an adjustable rate mortgage,
Yeah, let's
there's a
focus
straight
there.
adjustable,
Okay.
which would be it adjusts every whatsoever period of time. Most of those are every 1 year. So if you get
Tied to the LIBOR? What's it
can
tied to?
Not so much anymore. There are some that are still out there that are tied to the LIBOR. There are other indices. There's the SOFR now.
Okay.
But they're tied to some index.
Okay.
And the index is a whole different story, but they're tied to an index. That's something that changes. Most people can relate to the prime rate. Okay.
Okay.
Although they don't use that for first trust deeds. Those are used for home equity lines of credit.
Yes. Prime
but
plus
that-
2.
Right. That type of that.
Yeah.
So you've got the index plus the margin.
Yeah.
So the index is, what's the index? Is it prime? Is it the SOFR? Is it the LIBOR?
Okay.
Is it the Treasury? What is the index? And you can track that in the Wall Street Journal. You can
Yep.
see what those changes are over the years, where they're up and
This
down.
keeps the mortgage lender honest, and it keeps a standardization on what the rate will be, so I'm not worried about being manipulated. I can see what the rate is.
You can see exactly how it's going to adjust.
Right.
The margin is tied to your note on that loan. That's what you sign on. You're saying you agree to pay this margin plus your index
Yeah.
on your loan. So when you said prime plus 2,
Yeah.
the plus 2 is your margin. That's
Yeah.
tied to your actual loan. That's what you're agreeing to. I will pay whatever prime rate is plus 2% on my loan.
What
Now,
is prime today?
today prime is 7.5%.
All right, so is prime plus 2 a standard, or is prime plus, what is the standard?
I
the
think
margin?
prime plus 2 has been a standard for
Yes.
a couple of years.
Yep.
It's beginning to come down now.
Lower than 2.
It is.
Okay.
Now, you can find on an equity line a prime plus 1.
Okay.
There are ways to enhance that depending on the lender, where if you agree to automatic payment from your
Bank account.
then maybe you get a little bit less, like
Okay.
prime plus a half.
Okay.
It is getting more
My
competitive.
credit score would be a
The
factor
credit
here?
score helps. The worse the lower your credit score, the higher the margin's going to be.
Okay.
So there are changes, but prime plus 2 is probably a pretty good example of what an equity line would.
So that would be a
at.
9%.
9.5.
Let's talk about what an equity line of credit is. So I've already got a mortgage on the home. I've got an $800,000 mortgage. The home's worth maybe $1.2 million. So I've got a little equity baked in there, $400,000 in equity in that scenario. So that $400,000, is it accessible for this home equity line of credit, or how do they determine what type of HELOC or home equity line of credit to give me?
Yeah, so that's what it is. So it's an acronym, HELOC.
Yeah.
Home Equity Line of Credit.
Yes.
Okay. There are also things called HELOans.
Okay.
And a HELOan is a home equity loan.
Okay.
So it's a fixed rate. It doesn't change. It doesn't adjustable. It's not a line of credit. You get a fixed amount. It's like a second trustee.
Okay.
Okay.
So let's use my scenario. We got $1 million home.
Yep.
That was purchased. There's an $800,000 mortgage on it, first mortgage, and the home is today worth 1.2.
Right. So worth 1.2. you can access 90% of that
Of the
if
current
you
equity
qualify
value.
of they call that CLTV,
Okay.
combined loan to value. So you take your $800,000
Okay.
first, and then you can go up to 90%. So whatever that second is, so
appraised
90% of the appraised value. So if appraised at
1.2,
1.2, then you're talking about You're talking about
another $200,000-$300,000.
yeah. You're talking about $220,000.
That's what I would have access to, assuming I have a 700 plus credit score.
You got to have a good credit score. You got to qualify based on income and all that sort of
And
thing.
I could be
primary
at 9%.
residence.
And I could, it's got to be. It can't be an investment property. It's got to be a primary residence.
Right.
So that would be in your prime plus 2. We're talking 7 plus 2, 9% on that $300,000.
It's 7.5 plus 2, 9.5.
9.5.
Yep.
Okay.
On that $200 and some odd $1,000 loan, interest only. You don't have to pay principal toward it.
Okay, I've got
You
a
only-
follow-up question here.
Yep.
Okay. They amortize a 30-year mortgage very uniquely, where they get most of their interest early.
Yep.
And then as the time lags on year 10 through 30, it's slower to pay the interest because they're trying to collect it early because
Yep.
they're selling those
That's
loans
right.
off. So anybody who's paying a mortgage today looks at it and says, wow, it's been 3 years. We still owe about the amount we paid for the house.
Yeah.
And that's because the amortization schedules collapsed in the early years, right?
It's front loaded.
It's front-loaded.
So on your standard amortized loan,
Yes.
it's front loaded. People use home equity lines of credit, astute people, as first trust deeds.
Yeah.
Because they are not front loaded like that. They're interest only loans.
Yes.
You decide the principal you're going
That's
to pay.
where I'm going.
Simple interest.
So the HELOC, the home equity line of credit, the 220, I'm going to now borrow against my $1.2 million. That is a 10-year schedule. What's the schedule?
10-year borrowing timeline.
Okay.
That you can use. You
Yeah.
can borrow, pay back, borrow, pay back. The
So
line
it's a
of credit
line
is
of
open.
credit.
Right?
I don't need to take it. It
No.
can sit in the bank.
It can sit there and just be available for a rainy day. Once you borrow from it, you have to start paying on
All
it.
right. So no interest is accumulating. My 220 sitting in my checking account because I qualified for
As
the
it-
loan.
Yeah, not necessarily sitting in your checking account. It's available to write a check
Checks
on.
against.
But the money's just on the credit line. Think of it as like a credit card with an available access
Okay.
that you haven't tapped into yet. You haven't used the card.
I may need 30 grand for a pool.
You can write a check on it.
And so I've got 190 sitting there because I used 30.
That's right.
So I'm now paying interest on the 30, not the 190.
Correct.
Well, that's quite convenient.
Yeah.
Is it allowable in the law? We're getting very nuanced here, but is it allowable in the law for me to take my HELOC and pay down my first mortgage with it?
Sure.
That's permissible
Sure.
in the
You can do
HELOC
that.
rules.
Yeah, absolutely. You
Okay.
can use the money for whatever you want.
All right. This is considered a second mortgage?
Correct.
This line of credit? So
Most
they-
of the time.
they-
There's sometimes you can do them as a third, but it's a rare thing.
But it's sitting as a second position. First
Yes.
position belongs to the original mortgagee, right?
That's right.
And then the HELOC, perhaps at my local credit union, they sit in second position. And the only time that matters is if I'm selling or the property's changing hands, they get paid second.
It's not even, that's not really when it matters, because if you
When does
sell
it
the
matter?
property, it matters if you stop making payments.
Okay, and we
If
got to
you go into
foreclose on the
default.
property.
Right. So here's why the second trust deeds or home equity lines of credit are higher rates.
Okay.
They're more risky. It's
a higher risk loan.
If you stop, so James, you've got your house, everything's going great.
Yep.
All of a sudden you lose your job.
Yep.
You can't make payments anymore. You're giving up on life. Your home goes into foreclosure.
Okay.
Okay. That first trust deed gets paid first.
When they
so if
sell it
property
in
values
foreclosure.
begin to go down.
Yep.
Right. So if it goes to foreclosure sale, the property values start to go down. It's going to chip away at the second trust deed availability for them to get their money
Yeah.
before it gets to the first. Additionally, in order for the second to get paid back through a
Yes.
foreclosure, the first has to be perfected. So that they're motivated to make sure that the first gets paid off. It has to get paid off first. Sometimes you'll find these second trust deed lenders, if there is enough equity, that they'll just buy out the first and move into the first position. So there are some things, but it really only matters if you go into default.
Okay. What percentage of mortgages go into default in the life of the mortgage?
It depends on what period of time we're talking about. So
Currently.
today it's not bad. It's interesting you asked that because I just saw these stats
Yeah.
about 2 weeks ago. So I'm going to try and recall. I believe that today we're under 6% of all mortgages
Default.
that are currently in default.
Define default.
That's somebody that's 90 days or more down on their loan.
Okay. So 30 days late is not a default. It's a slow payer.
Right.
Right. What's the punishment for being a slow payer?
Late fees.
Late fees. So this begins to be hard to manage.
Oh, yeah. They add up.
Yeah. And are the laws such that if I'm 30 days late, it's one fee. If I'm 60 days late, it's worse?
No, it's not worse, but it compounds.
It's compounding.
And your credit gets affected. So
Okay.
what people need to be aware of is when you have a mortgage, typically it's due on the first of the month.
Yeah.
But you're given a 15-day grace period. So you don't have a late payment for 15 days.
Okay.
So a lot of people take advantage of that and they push it to the envelope and
Sure.
they just pay on the 14th day. You risk, if you go beyond that, now you have that late fee. But
Yeah.
the other thing to be aware of is it will not show on your credit report unless it's more than 30 days late.
Okay.
So even if you're 25 days late, 26, 27
Okay.
days late, and you pay the late fee, your credit still looks good.
It's just an inconvenience for the lender, but it's not disrepair on my credit.
Right.
Oh, interesting. Okay, that's a nice clarification there. All right, so what's the worst defaults have ever been? The Great Recession, 2008?
Yeah, I mean, for all intents and purposes, that was when
worst?
there were just so many defaults and properties were just going back to the bank and there
What was
just
the
no
percentage?
keeping up. Yeah, I don't know off the top. I'd be purely
the
guessing,
30s?
but it was high. It was high. It was probably north of 30.
North of 30.
What saved, I think, a lot of those homes was, if you recall back then, they were working out the mortgages and doing short pays and short payoffs.
Yeah.
And they were working it out and tacking interest to the end of the loan.
Yeah.
And so people were staying. We'll get into a little bit of history
Yeah,
because I think
please.
it might be good, just even for
Yeah.
younger homeowners that are looking,
Yeah.
or younger buyers that are looking to get in, to kind of learn from history. So pre-2008, the market was filled with really bad loans.
Yeah.
A lot of these were called subprime
Okay.
or Alt-A. Those were
Okay.
the two kind of
Not
categories.
A-paper, but-
They weren't A-paper. They weren't Fannie Mae and Freddie Mac loans. They weren't FHA loans or VA loans. They were loans done primarily by Wall Street bankers.
Okay.
The guidelines were drawn up by them. They were very hungry. They were greedy.
Okay.
And when the market slowed down, so we had a very robust market in the beginning of the 2000s.
Yes.
Began to slow down. Product started to expand. So I'll give you
Inventory availability.
Product of mortgages began to expand.
Okay.
Okay.
Proliferated. Yeah.
Right. How
Yeah.
can we get
Yeah.
more people to buy homes?
Understood.
Is really, so how can we expand our guidelines
Yeah.
to qualify more people to buy homes?
Yeah, right, right.
So for many years, I'm talking about decades, there were two big national lenders called Union Bank and Coast Federal Savings. I'm sorry. I'm going to go back. World Savings.
Sure. World Savings Bank.
And World Savings Bank
Sure.
and Coast Federal Savings.
Yeah.
Okay.
Yeah.
They were doing what we call stated income loans.
Okay. Which
Where-
means I state I just tell you my income.
You're telling me your income, you're self-employed, you make a lot of money, but
But I don't need to prove it.
you can't prove it because you take so many write-offs,
Yeah.
but you're going to put 20% down on that property. You've got skin in the game.
Okay.
The
So
default
Wall
rate,
Street's going to loan on that because I've got skin in the game.
that made a lot of sense, right?
Yeah.
That made a lot of sense.
Yeah. I
and the
won't default. I got 20% sitting in this house.
default rate was minimal. It was like 1 to 2%.
Yeah. Yeah.
So what happened was, moving forward past 2000, as the market started to slow,
Yeah.
they took the concept of the stated income loan and expanded on it. And so now it used to be you had to have really high credit scores. You had to have the 20% down. Oh, why don't we just do this with some lower credit scores? More people will qualify. Okay.
Yeah.
There's another 2%, 3% of the population qualifies.
Yes.
Great. Well, that's not quite enough. We went through that. What if we make it less down payment? How about 15% down? Maybe that'll still work. So if you think about how this
Yeah,
is working,
credibility
now let's
creep.
continue to lower the requirement for
Yeah.
the credit score.
Yeah.
Lower the requirement for the down payment, increase the risk, even to the point where,
Yeah.
and this is where we went, okay, just before the crash.
Yeah.
0 down, and you could have had a bankruptcy yesterday.
Wow.
That's how bad it got.
Because, would you say that's Wall Street pushing the envelope there?
Complete greed.
Okay.
It was complete greed.
Were they
So-
securitizing these in bundles?
Oh
Is
yeah.
that's
And
what
your
we're talking
pension
about.
funds and all
Yeah.
that, they were all buying these. They were buying the
bundles
derivatives.
because mortgages were the safest possible investment.
They were secured by real estate.
And we got
of course.
and we got skin in the game.
That's
the guy
right.
living in the house has got skin in the game.
That's right. So what happened?
It came apart.
Property values stopped going up.
Yeah, for the first time
They
in
stopped.
years. Yeah.
And then what happened? Default started to happen.
Well, I don't want to live here if it's worth less than I owe, and I can't make this payment anyway.
And now I can't sell it.
I bought too much house.
And now I can't sell it. So property
No.
values begin to go down. Now the water line of the mortgage is above the value of the homes.
Yes.
And that was the beginning of the end. And believe me, if I knew investment banking at the time,
Yeah.
I saw it coming from the inside.
Yeah.
I would have loved to have shorted the market and done all
Yeah.
that, but I wasn't
So
smart enough.
you were in this space because I remember living through it as an investor. You were in this space and you watched the loan quality getting weaker and weaker
Yeah.
and weaker. The loan packages being sent off to the corresponding lenders getting weaker and weaker and
That's
weaker. At what point, just if you could be as clear as possible and as sincere as possible, at what point in that degradation did you honestly realize, because it's got to seem like a good idea if Wall Street thought it was a good idea. These are the people buying these loans. They're the ones buying the bundles. It had to feel like, well, they know what they're doing. They're the ones loaning the money. When did you sincerely feel this is, we're skating on thin ice here?
You want me to tell you a story?
Yeah, tell me.
2005.
Okay.
So we were a big lender. I had founded a company in 1999 that was growing, and we were almost nationwide, and we were doing wholesale and retail, direct to consumer.
Yeah.
We even wrote some product but it was good product. It was high down payment, high interest rates. Think of it as hard money.
When you say right product, you mean lend the money.
We were lending money.
You were lending money,
right?
yeah.
But the buyer of everything we lent was Wall Street.
Yeah.
So there, Bear Stearns, Lehman Brothers.
Yeah.
I mean, I can go down the list. Countrywide Securities.
Those
ton of
names
them.
used to be important.
The reason I said those
Yeah.
names and not
Those
others
are-
is they're
yeah,
not around
because they're
anymore.
not around, yeah.
Right. So 2005, Mortgage Banker Convention, Chicago, extremely decadent. These conventions
Excessive.
were it was extraordinary. I'm telling you, even comparing to what they have today, which is not even a fraction of what they had back then. These conventions, to give you an example, let's just use Countrywide. You've been to conventions,
have.
you see the booths, right? And some
Yeah.
of them are really nice, and they've got things like this, right?
Yeah,
behind us.
elaborate.
And and you walk in, they have little meeting rooms. We're talking about 3-story meeting rooms, like
Spiral staircase.
they came in there and did construction for 2 weeks for a conference
For a week.
right? It was just crazy.
Yeah.
And the parties were off the charts. I mean, serving caviar and flowing alcohol and all the
Yeah,
things, right?
yeah.
But these were designed so that you can meet with people. Back then, we didn't have Zoom, and we couldn't face to face.
Yeah,
We
right.
didn't even really. Very few people were like online. You didn't have a LinkedIn and all
This
this
was
stuff.
the gathering of the industry.
How do you I've never met James. I spoke to him on the phone. I
Yeah.
like his voice.
He's gonna
I
be
love
at
when
the
he buys our
convention.
loans, but now I get a chance to meet
Yeah.
you. So at a party, it was at a high-end bowling alley, Lucky Strike.
Sure.
Okay, in a high-rise building, everything. So, but we're doing meetings in the back, and the party
Yeah.
was in the front. I'm meeting our trader from Bear Stearns for the first time.
Yeah.
And I'd spoken with, they've got kind of a
What's
floor
a
manager.
trader for Bear Stearns do with your mortgages? What are they
So
doing?
they're the ones that are designing the mortgage products and creating the derivatives and setting up, chopping it up to be sold and all those things.
So they build the package, the application you fill out with the client.
This is what they do. They say, these are the loans that we are willing to buy. We'll buy these buckets. We will buy loans with a credit score of 600 up to a 95% loan to value based on these parameters and this kind of documentation.
All right.
These are the pools of loans that we're interested in.
And they have buyers for these loans, investors for these loans.
They would sell these to the pensions, to the big.
Massive.
We're talking about like,
Sovereign pensions, municipality pensions.
yeah, your
General Motors pension.
all of those.
Yeah. Okay.
All of those.
I got it.
That's where ultimately the money and
So
where these
he's
loans.
a trader.
He's a trader
He's there to entertain because you guys basically are building product he can resell.
that they buy.
Yeah.
They buy from us.
Yeah.
Right. So I meet the manager back here in the background, in the back of the building.
Yep.
And kind of meeting rooms, and the trader is late, and okay, we're
2005.
schmoozing. This is 2005. All of a sudden, and I was a kid back then.
Sure.
You know, I'm in my I'm in my
Yeah.
late 30s.
Yeah.
But this kid comes in, and I'm saying he's probably 26, 27.
Yeah.
I mean, but exactly what you picture Wall Street guy, slick back hair,
Yeah, suit.
and an
Yeah.
overcoat, the whole thing,
Yeah,
right?
yeah.
From right out of the movie Wall Street.
Yeah, okay.
And we sit down and we're talking about, you know, what are we going to do next year? What are we looking for? Where do
Yeah.
you see product
He's
going in the market?
forecasting
All
his
this.
income.
And I stopped at some point and I said, what are we going to do when property values stop going up? I said, because these loans that we're doing, they're not going to pay.
They're 100% tied to property values increasing.
100%.
It's the only way they're valuable.
100% of
Yeah,
it.
yeah.
And I said, and we're seeing so much fraud. And we didn't have the fraud controls that we have today
Yeah.
with technology. There's so much fraud. I said, we
Fraud
as a
meaning
lender,
faking my income to get a loan.
fake everything, fake buyers, what we call straw buyers.
Oh, sure,
Which
sure.
is, if you ever saw the movie The Big Short.
Yeah, sure.
Or
I love
if
that
not,
movie.
go watch
Yeah.
it again. But you where they talked about like the landscaper had 15 homes,
Yeah, right.
stated income or
Yes.
no income on his application,
yeah.
or the stripper that had that or
Everyone's
whatever.
betting on the increase in value.
These were straw buyers that were brought in. They give them a little bit of cash, and they put their name on it.
Yeah.
And they take the online risk, right? So
Yeah.
I said, what are we going to do when property values are no longer going
It's
up?
a thoughtful
Like, this is
question during this window. of
Very
time.
thoughtful.
Yeah.
So instead of this guy saying, well, here's the plan and here's what we're going to start mitigating, he literally stands up from the table, slams his hands down and said, if you don't like it, you don't have to do business with us. And he walked out. So this is a kid, a trader that's buying
If
our
you
loan
don't
pools.
like it, you don't
You
have
don't
to
have to
do
sell
business
this.
with us.
That's it. Manager apologizes, whatever, but that
Wow.
was the mentality.
Wow.
And so that's what got us to where we ended up.
Yeah.
And so
Yeah.
when you ask me when, I saw it in 2005.
And you believe his act there, whatever that was, that inappropriate behavior was indicative of a failure to do due diligence, to recognize the moment, to understand that that was a risk. It did not seem to dawn on him that this is actually a risk.
I think the opposite. I think he knew it was a risk,
He
but
didn't like
it
you
was
bringing
not
up.
his risk.
Yeah.
He was protected by a company, Shell, this giant Wall Street company.
Yeah.
He was making tons of money. He was probably getting accolades for generating the amount of capital he was generating. And everybody looked the other way, all the way up the chain, because they're all making money on
Everybody
it.
had an incentive to not ask that question.
There was no regulation of it whatsoever.
What's changed, Brad, today in the mortgage space? What's different now because of that event that we all suffered through?
That's such a great question. The product that we write today is probably some of the best product that we've ever written. The ability to check on somebody's qualifications, something called ATR, ability to repay, was instituted after 2008. So the Dodd-Frank Act was something that came out after
Sure.
2008 that
Yeah.
said, hey, we're going to re-regulate everything here.
Yeah.
There's going to be all sorts of disclosure requirement. There are going to be requirements on what we call qualified mortgages. These are mortgages that, hey, you want protection? If you're doing this
Yeah,
loan,
yeah,
you want
yeah.
protection? You have to do these things. These are called qualified mortgages. So you want to do an FHA loan, a VA loan, a Fannie Mae or Freddie Mac loan, those are qualified. You follow our guidelines, you've got protection as a lender. You go outside of those guidelines, and we call those non-qualified mortgages, non-QM. That's
Yeah.
where that comes
Yeah.
from. It's on you.
You're taking
Right?
the risk.
It's on you.
Your
But-
underwriting's your underwriting.
But you still have to do certain things. You can't overcharge. You've got to have a ability to repay, which is you got to somehow prove somebody can repay that loan.
ATR.
So that's really where we ended up, where it's like, okay, much better product, got better fraud guards. We've got the ability to really verify things. Now, I will say, now we're in 2025, and we've seen the non-QM product expand a bit.
Okay.
But we still have to do the ability to repay. So
When you say
let's say expand.
when you say expand, you mean dilute the quality.
Yes, you could
Okay.
say that,
Yeah.
but let me explain.
Okay.
So non-QM could, is really for the people that fall outside that box, right? Of you don't have a
So
W-2.
It's more than
that's-
$750. There's a larger loan.
Well, those are jumbo loans, and yes,
Okay.
you can get a non-QM loan above the limits
Okay.
for FHA, and what we call conforming loans.
Yes.
Conforming is FHA. I'm
Right.
sorry, conforming is Fannie Mae and Freddie Mac.
Right.
Right. That's a conforming
government
loan.
agency backed loans.
These are all those backed loans.
Yeah.
So it could be that, but it could also be just you're self-employed, so you're making enough money, the old stated income,
Sure.
but not stated income anymore. We have to calculate your income, but we're going to do it differently.
How?
So James, you're self-employed.
Yep.
We see your tax returns and like, holy smokes, man, you've got the best accountant. They know all the loopholes for the IRS.
Yeah.
You are doing it right,
Made
but your net
$18
income
last year. Yeah.
right.
Right.
Your net income is not going to qualify you for a loan.
Right.
But you're like, wait, I'm making money, man.
Yeah.
I've got
Yeah.
bank statements that show I'm making $50,000 a
Yeah.
month.
Yeah.
If you average my bank statements out, that's what I'm making.
Okay.
And I got money left over every month. Okay. Let's use that to qualify James. He has the ability to repay.
Okay.
Let's use your income as
So
on
the
your bank
formula
statements.
allows you to use
Take a
bank
certain amount for
statements.
expenses.
A formula? Like a percentage?
Correct.
Okay.
We take a certain amount, call it 50%, that's for expenses.
Okay.
That's what's left over. Take your debts into consideration. What do you have left over for mortgage, right?
Okay.
Ability to repay.
Okay.
Okay. So those things. DSCR.
Okay.
So you're familiar with, but let's
Yeah.
educate
Yeah,
the
please.
audience on DSCR.
Yep.
These in the commercial world, commercial loans. We've always had DSCR. We don't call it that.
Yeah.
But in the commercial world, so if you're buying an office building, a strip center, apartment buildings, that type of thing.
Yeah.
You're the guarantor on that loan, so they want to make sure you've got good credit and so
Yes.
forth. But it's not your income that qualifies for that loan; it's the property income that qualifies for it, right?
Got it. Sure.
So you're buying a property, an apartment building, and it
Yep.
generates X amount of income, and it has leftover, cash flow.
Yes.
That's what's going to qualify you for that mortgage. What does that property or building generate
Cash
to
flow.
pay back the loan?
Yes.
Okay. DSCR, debt service coverage ratio.
Got it.
That is now used on residential
How so?
properties. So you're an investor. You want to go buy an investment property, but again,
Yeah. Yeah.
as a standard, don't show enough income to qualify
Right.
on your standard non-owner occupied purchase. But the property is a great buy.
Yeah.
The rent that you can get on it based on what we call rental survey, that's an appraiser who says, hey, here's the rents and what it's going for in the area and what you expect to get on this property based on its size and quality and location, that will cover the mortgage payment,
Okay.
the PITI that we learned earlier.
Okay.
So if that debt service, that rent will cover the PITI, you can get that loan.
Got it.
Again, non-qualified,
Sure.
so it's riskier for the lender, higher interest rates because of the risk, right? Risk and reward.
I have a
But
question.
you can get that loan.
I have a question on that loan. The investor, a lot of people watching have investor properties. So this is the loan they're doing and they're used to doing. Do I have to have the tenant signed up to get that loan?
No. So
Because
you
typically in
don't,
commercial properties, to build the building, I have to actually have long-term leases. Well, the building I'm
That's
building,
right.
and then they'll loan the money to build the building.
yeah,
But-
you don't.
But not here. It's just going to be, I'm going to use it as a rental. I declare I'm going to use it as a rental. I'm going to use it as a property that will collect rent for me. And then you guys do the appraisal to figure out what kind of rent I can get.
That's right. So the appraiser has two jobs.
The value
How
of
much
the
is the
property.
property worth and what's the rent it's going to yield.
Got it. So that's a new kind of loan
Yeah.
with a
it's
new
relatively new.
qualification.
Yeah.
Interesting. All right. So tell me about the health of the mortgage market today. I know not a lot of movements happening in the space. And that's because there's not a lot of inventory and the
Yeah.
people are not moving. They're redoing their homes. They're redoing the interiors of their homes.
That's right.
A lot of construction work going on, but not a lot of new inventory being built. So what's the health of the mortgage market right now?
Well, let me throw a question at you, Jim.
Yes.
What do you think the number one reason is that we don't have enough inventory in the market?
I believe there aren't enough buyers presenting themselves demanding inventory.
Okay. I'm going to take you back to 2020 and 2021.
Okay.
What stands out the most to you about mortgages? Interest rates.
Well, I know, yeah. We were a low interest rate environment. The rates have been driven up.
But back then,
yeah,
rates were in
quantitative
the
tightening.
2s and 3s.
Yes, that's everybody had these
And
low
everybody
crazy
that
rates.
could qualify for a loan
Yep.
went and refinanced into these, and nobody wants to give them up.
Yes.
So you're finding people that their kids are aging out of the home.
Yep.
They're living in this 5-bedroom home, but their payment is so low.
Yes.
Because people don't realize the property value is not as impactful
It's the
as
interest
the
rate.
interest rate.
Right,
And so
right.
when they were able to cut their mortgage payments in half,
Yeah, they can get more house.
they're living in a 5-bedroom home for less than they would pay for a 1-bedroom apartment.
No, that's right. That's
And
right.
so that has caused a big hang up in the amount of inventory that normally and naturally turns over as people age.
Right.
People are staying in their homes longer. I have this conversation all the time.
So do we have to wait this out?
A lot of it is waiting it out. It may be that interest rates come down far enough to spur the market up again. Housing, building homes is a big part of this. We see a lot of that in
Vegas.
In Vegas,
Yeah.
there's a lot of homes being built.
Yeah.
We'll see what happens over the long term with that. But those are the things that are really going to help.
I do not see interest rates coming much further down. I think we're in and this is just my view
Yeah.
as an investor, giving you my economic understanding of how things work. I believe we're at an equilibrium. We're close to par in the interest rate value. I believe that. We may have incremental adjustments just to kind of loosen the fabric a little bit, but anybody who thinks we're going to ever get to 3 or less is insane. Not in your lifetime is that happening again.
Well, I agree with you there, and I don't think we'll see in
We
the
will
3s
not.
again. Now, could we possibly get in the high 4s or something? Possibly, but here's why I'm smiling when you're saying
Yes,
that,
yeah.
because it doesn't matter what you said right there.
Yeah.
Whatever you said is just a guess.
Yeah,
but
for
here's
sure.
here's
For
what
sure.
I love about it.
Yeah.
Be bold with your guessing.
Yeah, that's
because
right.
guess what? Be as bold as possible. Say they will come down
Yeah.
to 4% within the next 3 years.
Yeah.
And guess what? If they do, you're a hero.
Yeah.
Man, you're gonna roll that tape over
Yeah,
and
right.
over.
Sure.
But if they don't,
Yeah.
you'll just never play it again. Everybody will forget.
No, that's right.
So be bold with your predictions. But I think it's really tough to say. We're definitely way better off today than we were just a year ago.
We'll just
We're
back
down
up
in the
100 years.
mid-6s.
Just back up 100 years.
Yeah.
Interest rates are pretty low.
Yeah, I think I think it's hard for people to think about even 40 years ago
Average
in
it
the
out.
80s. I think it's really tough for people to think about rates that were in the high teens and in the late 80s and so forth. I think that's a really tough thing to really associate
That was an
with.
extreme, and so is the 2%.
Right. I think that if we look at 25 years, we look at the early 2000s through now,
Yeah.
we're about average.
I know.
Okay, and
Yeah.
so I think your statement's spot on.
Yeah.
But I do think that we will see lowering of rates over the course of the next 2 to 3 years with the
Incrementally.
current administration, with the pressure to bring
Rates down,
the
Federal
rates down
Reserve.
from the Federal
Yeah.
Reserve. And as we see
Treasuries are not responding
they're
to
not.
that.
And they didn't this last time. So I really loved when everybody pushed out rates are dropping, and it's not a direct correlation
No,
to
it's
mortgage
not.
rates. We actually saw mortgage rates pop up with that. But here's what I think does happen: there is some downward pressure. There's downward pressure on the amount of debt that the United States is servicing.
It helps the U.S. deficit.
It
for
does.
sure. For sure.
And because of that, and because of the volume of mortgages and home sales has shrunk so much from a high of about 7.5 million to where we're at this year, I think we're going to end up around 4.5 million.
Yeah.
That's had a big effect. So what happens again? Just simple economics, supply and demand. Margins will be compressed.
Yep.
And we'll see bigger volume from compressed margins. It'll help bring the rate, because margins are way higher than they should be.
Yes.
Right now, they're way higher than they should be. We
Right.
should see lower rates today based on what the 10-year is at. So I do think that we see rates get a little bit better. I think, again, bold statement, I think we wind up under 6% by middle of next year.
That's probably right. Somewhere between
Well, thank you for
5
agreeing.
and 7. Somewhere between 5 and 7 is going to be equilibrium on the market. It
Yeah.
really is. So if people, I guess I say that, and the reason I'm even bold to say it, and want to be bold in saying it, is because I don't want people waiting for rates to get to some low point to make their buying decision, because home prices will increase. Home prices will rise up. You've just got to get yourself into that game. You got to get into that game.
Let's focus on that.
Yeah.
That right there, I think any listener, anybody that's owned one home and not more than one home,
Yeah.
or really wants to get into their first home, but is waiting for property values to decline or interest rates to decline, need to listen.
Yeah.
Look at property values over the last 50 years.
Yeah.
I'm going to take it out even further, 75 years. How many years did property values decline in the last 75 years? Take a guess.
3.
7.
7 years.
7?
In 75.
In 75, 3 of those years, the mortgage crisis.
Right.
So,
Which
what
was
you
an
have to-
artificially man-created problem.
It was.
Yeah, it
But-
wasn't
But
natural
the bottom line
marketing.
is, anybody that bought a house, even before the crash and held on to it,
Yeah.
they're in a better position today.
For sure.
The number one for most families, and we're not talking about the wealthy people, whether they want to rent or buy, but for most families, the American dream is the number one way that they grow wealth.
Yeah.
And it's through the appreciation of their home. So let's talk for a minute
It
about
is.
so let's talk about affordability. So, Trump is not the first one to talk about a 50-year mortgage.
Right.
Right.
And we want to get into that a little bit. What is a 50-year mortgage and how would that help us?
Okay, so I just did a piece on this. This is really easy to talk about. 40-year mortgages have been around for a long time. Interest-only mortgages have been around for a long time. So I get that the people are passionate about, 50 years, I'll be always paying the man. I'll never own my home. But let's talk about a few real stats here, okay? The average period of time that somebody stays in a mortgage is
7 years.
7 to 8 years.
Yeah.
Bingo.
Yeah.
Okay. So are you going to keep a 50-year mortgage in 50
Never.
years?
Nobody keeps the 30.
Yeah.
Yeah, no.
So, okay, let's not think long term. Let's think 7 years.
Yeah.
Okay.
'Cause that's
What is it-
reality.
What does it look like? How does that amortize over 7 years
Yeah.
versus other loans?
Yeah.
And is there a real benefit to being in the 50-year? And nobody really knows, and I'll tell you why. It depends on the risk factor that the lenders associate with it. So today, if you want to get a 40-year mortgage, do you think the rate is higher or lower than a 30-year?
I would say they don't know yet. They haven't ascertained the risk totally. I would say higher.
Correct.
Yeah.
So a 40-year mortgage is going to be a higher rate than a 30. So
Yeah.
probably it's logical to say a 50-year mortgage will be a higher rate than a 40.
For sure.
How much
It takes
higher?
longer to get my money back as an
Right.
investor. Yeah.
Bingo.
Yeah.
That's right. So how much higher is it going to be? Is it going to be a 0.25% in interest rate? Is it going to
Yeah.
be a half? Is
Yeah.
it going to be an eighth? Is it maybe just going to be a fee of some amount?
Yeah.
So there's no real predicting, but I ran some numbers.
Yeah.
And here's what the numbers show. If I did a 30-year mortgage and I take into account, and I say doing from a 30 to a 40 and a 40 to a 50, that there's a 0.25% change in rate.
Okay.
The change in payment on an average
Good. This is
of
good.
a $600,000 purchase price
Okay.
with 10% down
30-year, how much?
is the delta between the 30
Yeah.
and the 50 is $60 a month.
That's it. Because
The
the
higher interest rate.
amortization schedule and the higher interest rate offset the time.
Yes,
Interesting.
that's right. Now, can that make a difference for people? Sure, it can.
Maybe.
Maybe they allow a little bit higher debt to income ratio on
Yeah,
those.
yeah.
So there's other factors here.
Sure.
But people freaking out about it is not the right way to
No,
go.
no.
This is a
No.
tool.
No, that's
okay.
right.
That's
We're just
all
trying
it
to
is.
get you in the game.
To get you in the game
Yeah.
and get that 75 years of appreciation that only 7 years have gone down.
That's it.
That's the end game.
That's it. And the reason people are on average in their 7 years is, number one, they change their taste. They want a different kind of house. They move, literally physically want to live somewhere geographically different. And the home is appreciated way beyond the, see, if the mortgage rate is not the rate, the principal balance owed is descending and the value of the home is ascending, you get that alpha in the middle there, which is your equity.
That's right.
And that's where wealth is coming from. It's not from your job. For the people who are employed, which is 85% of the population is employed, those folks are making their money to retire from the equity value in their home. So if they're not in the home, the 20 and 30-year-olds who don't actually have a home, they're going to all have to be entrepreneurs. There is no other option.
There's
a
no other
job
option.
cannot set them free.
You're on the hamster wheel.
There's no way
you're
to be set
working to
free.
make your rent payment.
I've never interviewed an employee in that seat.
Yeah.
They're not financially independent.
Yeah.
I've not met an employee who's financially independent.
Yeah, it's very tough. Look, there are people that are very wealthy out there that have always had a W-2 job, but they bought a house, and now they're sitting on a
And they
million
have
or
stock.
2 million of equity. And then
they
you've
have
got
stock.
401k too.
Yeah,
But
the employment did not create
Yeah,
any of that.
that's true.
No, it was
I'll
the
give you-
decisions that created that.
that's true. I'll give you a really good example. This is a client I spoke to just this last week. They're older. They're both retired. They bought their current home 8 years ago. They were in their previous home for 20 years. They sold it,
Okay.
took the equity,
Okay.
and bought a new home. This is around this in Oxnard. We're talking about Oxnard.
Yeah.
In Oxnard, near the beach.
Okay.
They bought it for $600,000 8 years ago. Guess what it's worth today?
When did they buy it? How long ago?
8 years ago.
They bought it for $600.
600, and it's a block from the beach.
$2 million.
Very close. $1,750,000.
Yeah.
The appraisal just came in.
Wow.
Okay, so is that wealth building?
And if they did, let's just say they mortgaged, they probably paid cash for it with the equity from their home. But let's assume they mortgaged all 600. They'd only owe about 5 at this point.
That's right.
And it's worth almost $2 million.
That's a perfect example of what we're talking about here.
Yeah.
So for people to say, you bringing this full circle, I want to wait.
Yeah.
Why are you waiting?
Yeah. Yeah.
Why? You can always refinance.
Start smaller.
Yeah.
Just start with a smaller home. You don't
just
have
get
to have
into
the
the game.
McMansion.
That's
get in
just
the game.
get in the game.
Yeah. And then you can go from the 2-bedroom to the 4-bedroom.
That's right.
But get in the game. It's your equity that will allow you to increase the value of the home, not the interest rates.
Yeah.
It's the equity.
That's right.
Yeah, that's it. Okay. We've covered a lot on mortgages. I wanna now talk about you, Brad Rice, the man who's financially independent through owning businesses. You have observed, you're an observant guy. Okay. We talk about these kind of things. You and our friends, we talk about this kind of stuff all the time. In your opinion, Brad, what is it that set you free financially? What is it mentally, the skills that you had to develop? You weren't born with them. You developed them somewhere along the line. What were the skills you think, if you were to give the audience some list, what do you think those skills were that allowed you to do the things necessary to become financially independent?
Yeah, that's a very good question. Look, if I were really to peel back the onion and think about it, a lot of it has to be risk tolerance. So
personal risk tolerance.
Personal risk tolerance, doing things that others wouldn't do, risking signing loans on businesses,
that you're the
personal guarantees, leveraging and putting my own money into into businesses
with no assurances that it will work.
Just betting on myself.
Yeah, you just think it will work. You've got a hypothesis that this is probably the best path. I believe in myself. I'm willing to basically take a mortgage out on it.
That's right.
I'm willing to borrow to do this.
Borrow against your future.
Yeah.
Yeah.
So, okay.
So I think risk tolerance.
Taking risk.
Risk tolerance would be high on the list. Not caring what people think or say.
Oh, that's big.
It's a big one. It doesn't matter.
Yeah.
Here's the way I think about this.
Yeah.
It doesn't matter what I think or what I say. 50% of people will agree with me and 50% won't.
That's right.
It doesn't matter. I could take a political side. I could take a side on housing. I could take a side on any subject,
rates.
on anything.
Yeah.
50% of people will believe it and say, I agree with you, and the others won't.
Yeah.
Okay? So why not pander to the people that agree with you?
Yeah.
So just be bold in your own thinking, in your own statements.
Yeah.
And guess what? The people that you want to be with will gravitate toward you. So I've done a really good job of alienating myself from the people that are not in alignment with me and don't make me a better person.
Yeah.
And attracting the people that do. So I would put you in that category, right?
Yeah.
We haven't known each other all that long,
For
but
sure.
we met through a lifelong friend of mine. And he said to me, you have to meet James, okay?
Yeah.
He's a partner of yours.
Yeah.
And he goes, you have to meet, you guys are going to hit it off famously because he knows me.
Yeah,
He's known me for 40 years.
Yeah.
And what happened?
Oh, we're connected.
Immediately.
You and I are connected.
Immediately. Because he knew. He knows the type of person
Yeah.
that I attract. He knows the type of person you attract.
Yeah.
And so positive thinking,
Yeah.
not getting yourself down. I do a really good job. Look, I'm not immune. Nobody's immune from, moments of depression.
Sure.
Double
Yeah.
double guessing yourself and all these other things. And having a good life partner is a big part of that. But it's how quickly you overcome that and you come out of it and where you are on the other side. So I've done a really good job at training my mind to not allow me to ever go too deep. Okay? And people are really amazed by the resilience.
When you say go too deep, you mean pull these long threads that have a tendency to take us down these dark holes that we can't get out of.
And then you can't get out of it.
Right.
And I see too many people do that.
Yeah.
They get depressed and then they're not productive and then days turn into weeks and weeks turn into months. I don't let that happen to myself.
Why is optimism such an important factor and ingredient here? Why? I totally agree. I just want to get your opinion. Why does optimism seem to be a common denominator with successful people?
I don't know that I can answer the reason why.
Yeah.
It just is.
It is.
And so if it is...
Have you met a negative entrepreneur who was wildly successful?
No, unless they inherited the money and they're just miserable because they don't have any friends.
Entrepreneur.
Right.
That's not
an entrepreneur.
No, I haven't met one.
Yeah.
So if you have a tendency to be negative, down, depressed, this is your nature, you see the sour side of things, you got to get that ironed out. You've got to get that ironed out. You have nothing in common with winning and success if that's you. That's a promise.
And 9 times out of 10, it's because you are hanging out with the wrong people. Change your circle. Get with the people that elevate you, lift you up, and make you a better version of yourself. That's how you'll get there quickly.
No, that's right. You know, I find energy, like our friendship gives me energy. I don't ever feel like...
I agree. Let's go.
No, seriously.
Let's
you
go,
feel that way?
Let's go work out.
I mean, we spent several hours together before today's broadcast, and I feel energy lifted from the experience as opposed to energy drained. We all have people in our lives where when they leave our presence, it's a long exhale.
That's right.
That we need to recuperate, right? I would say we've got to spend less time with those people that require the long exhale.
So going back to like... what are the attributes?
Yes.
That's one of them.
It is.
I don't even, it's weird. I don't allow myself, it's not even unconsciously, I don't allow myself to hang out with people like that.
No, I won't take the calls. This is just to protect my energy. From a chemistry standpoint, I can't afford the negative energy.
Yep.
And I don't mean pessimism. People don't call me with pessimistic stuff. I don't have that kind of people in my Rolodex. But what I do have is people who want me to solve their problems.
Yeah.
They see me as some type of source in their life to solve their problems. Those are energy drainers, and I don't take their calls.
Yeah.
I've moved into leave me a voice message. I may be totally available. I may have my feet kicked up, and I see that call, and I go, no, not going to do that.
Not now.
And then I text them in the middle of something, please leave me a voice message.
Yeah.
I just can't afford the degradation of my energy.
I can't tell you that I do that all the time. It's the exact same thing. I'll see it. Hey, can we talk? No, send me a message.
Yeah,
right. Because
I'm
I don't
in the middle
need
of
that.
something.
I don't.
I'm actually in the middle of managing my energy. Damn
And
it.
maybe they do need my help with something. But tell me what you need. And here's the other thing I do. And I'm sure you do this. Because you employ people are looking to you for direction and leadership and all those things. They come to you with a problem. What do you demand to have with that problem?
I need your suggested solution.
Thank you.
Period.
That's it.
If you come, I'm going to tell you right now, I have a lot of people who work for me. You come at me with a bunch of problems more than once, we're going to have the nice discussion. Say, look, I appreciate where you're coming from. That's a great problem. It makes sense that's a problem. I can see why you're tripped up by it. What I'm going to need you to do is come up with the way you would solve this if I'm not on the planet. And I will edit your rough draft, and we'll come up with a solution together. We're going to do that one time. If you don't do that the next time, you just can't work for me.
I love
We
that.
are just not wired right together. It's not going to work. And I'm going to be mean. And I don't want to be mean. I'm a nice guy. I don't want to be mean.
You have such a great way of saying things. Anybody that's around you, and Scott tells me this all the time, he goes, dude, these things that come out of his mouth are crazy. But you have such a great way of saying things that are so direct, but this just so poignant at the same time. But that's one of them.
Yeah.
If you're going to come in with
a problem,
bring the solutions.
Yes.
I don't mind helping you with the solution.
Yeah. And I don't know if
give you feedback on it.
I don't know if you totally know all the solutions, but I want you to have thought this through.
And if I start solving your problems every time, what do I need you for?
Exactly.
So
you're in charge of something. I've hired you to be in charge of it. Please bring me all your great solutions from your vantage point. It probably will give me some insight into how I can recommend a better solution.
It happens all the time.
Yes.
So, and we'll probably not want to belabor this whole thing, but I do have an employee that does check me because look, my perspective is not necessarily the best perspective all the time.
Yeah.
And I may be reactionary because it's like, these people aren't doing any work.
Yeah.
We don't need them anymore. It's time to cut bait, where he'll check me. He'll say, is that the right thing to do? Or should you give them a period of time to correct? And I like that. I'm always, he knows now. We know how to work with each other. Yeah. He knows to come with me. Here, what about this solution?
Yeah. That's good.
What about this probationary
period?
And it's employee. So this is a kind of training that you can do in relationships to then get you out of, because a lot of people are depressed and some of it's chemical.
Yeah, sure.
And I don't.
That's well said.
And I don't want to discount that.
Yeah.
Because if you're battling with depression and it feels uncontrollable, I really want you to go seek professional medical help.
Yeah.
And the reason that I can speak to this is I do have a brother, an older brother, who's not with us anymore, who committed suicide 30 years ago now. And I didn't realize what depression was.
Yeah. And then it was real.
I couldn't react. I couldn't help him because it was so far removed from my reality that I didn't understand it, and he didn't let me into it because he knew I was so far removed. I didn't know it was going on.
He'll never
and
understand.
ultimately, he couldn't recover from it. So I realized that there's a chemical thing, and he was the most likable guy. Everybody loved him. Everybody thought he had the great.
But he was suffering.
But inside, he was broken.
Yeah.
And so if you're that person and you really want to have a better life, we're here once. You want to have a better life. You want to realize that American dream of home ownership and do all these other things, and you got to be positive to get there. At least do this. In the good times, really realize you do have a problem that you can't control. It's not your fault.
Yes.
And go get medical help.
Yeah.
And if you do that, there are ways that they can dial in the right medication to even things out so that you're thinking more clearly.
Yeah.
And you'll live a way better life and a more stable life if you're in that position.
That's great advice.
It's not everybody that we can just shake and go,
no,
you get with it.
See things better.
Right. You can't do that.
And I do feel bad knowing that there are people that really can't necessarily fix that, and they just bring this downer energy to their life.
Yeah.
That is a sad. That's not the way I'm wired. And thank heavens, it's a blessing to not be wired that way.
Yeah.
And so, any other ingredients? So we've got tolerance for risk. We've got optimism.
Yes.
Which we so agree with. We've got literally making sure we don't have people in our circle who can take from us the energy necessary to thrive and win.
Yeah.
So surround yourself with the right people. How about a mentor? How important is a mentor?
I think it's very important. I will tell you, I've not been lucky in that area.
Interesting.
I just haven't been, and I have to blame myself. And I think it's
How so?
I think it's because I've always depended almost always on just myself. And had I really realized that I could skip some of the heartache and learn from somebody else earlier on in my career, I probably could have saved my business completely failing in 2007, which was a complete life reset, because there probably was an older mentor that would have guided me into
navigate,
and that. And so I think that's a really important thing to elevate your success quicker. And I know people talk about volunteer your time for people that are successful and that sort of thing. So now, because I haven't been really successful at that on my own, I try to offer it to others.
That's great.
I'm happy to be a mentor.
I can see you being a very good mentor.
But I think it is important.
I was fortunate to have several great mentors, almost like trading them in as I grew and developed and changed locations and jobs. I always found I think not having a dad in the house kind of drew me toward these male positive role models. And I found mentors all along the way that literally changed my trajectory. And I would say to anybody out there, it's probably most crucial in your 20s and 30s when your brain is still shaping and taking these risks we're talking about. Risks aren't navigated so well in your youth. You don't think so clearly in your youth. Risk becomes disproportionate to your capacity when you're younger. Risk as an older person, Brad and I, risk as an older person is more proportionate to our abilities. So we can manage risk better because we don't take crazy risk at this point. But as young men, I know we did. We took risks that were disproportionate to our abilities, and only a mentor can bridle that. And you run ideas by a mentor, and you run it by and say, what do you think of this? I'm considering this. I'm going to move here. I'm thinking about this. What do you think? And they could walk you right off the edge of a plank.
That is something that had been missing from my life. And so I do think it's valuable. It's super important. I don't have that as a relative experience of my own. I will say that having the right life partner is also a big deal.
Picking your spouse.
I mean, I've been married for 32 years.
Yes.
And it's not without its issues. Anybody that says it's just not true.
Right.
Ups and downs. But at the end of the day, she's my rock. And honestly, if everything fell apart, didn't have anything I'm a driven person. I'm an entrepreneur. I want to do all these things. But if at the end of the day I go, unplug, I'm done. It's just her and I. I'm happy. And so a lot of people don't ever get there. They raise the kids. They play the logistics business. And then at the end of that, they don't know each other anymore.
They don't.
And that's the end of it. So I think that's really important. I think if you look at a lot of the really, really highly successful people that have enjoyed their entire lives, because there are very highly successful people who have been divorced many times.
Sure,
They're just
and
not very
unhappy.
happy.
And unhappy.
They're not happy.
Yeah.
That's a common denominator too.
That's good. Anything else that you think is a key ingredient? How about self-discipline?
Yeah, I think that can apply in a lot of things. You're in great shape. I work out all the time. There's a mental and physical connection in the things that I do, and one complements the other. So I could be having a really bad day that went out of control. Yeah. But I still get in and I get those endorphins going from working out. So that discipline is really important too. If I didn't have that, then I think that's where you wind up in that downward spiral that you can't control. Yeah. So one helps to balance out the other.
Yeah, I think of discipline, of course, for fitness because it's the thing we can control. We can make a difference. It's part of the self-esteem development. Yep. When you can totally manage the things you control and keep commitments to yourself, like fitness, like nutrition, those things, I think it's very important. But self-discipline is I think of it broader. I think of it when it's time to work, you fucking work. Yeah. When it's time to focus, you focus. When it's time to get down to it, you shut the door and get down to it, right? Yeah. I think of self-discipline in a way that entrepreneurs sometimes, and I guess this current culture kind of irritates me a little bit, these pretenders, the phonies, the fake gurus out there that are renting the yachts and the airplanes and everything. This group irritates me because it's so full of phoniness. There's no backdrop to it. There's no background to it. And I think what they're missing and never developed is self-discipline, the ability to actually grind it out. Don't sell a class. Yeah. Nobody wants to hear how good you are at selling classes. Yeah. What we want to know is the class you're selling. Tell me how you develop the mindset and skill set necessary to put anything in a book that someone will want to purchase. That's perfect. That's what I want to know, man. And that requires discipline. It requires discipline over time. Not discipline over a season, not discipline over 18 months, over a life. Yeah. That's where wealth gets created. That's where financial freedom comes from. It's these attributes you're talking about in discipline. Yeah, and I think there's another element to discipline. So there's a discipline of your time. Yes. So the control of your time. Totally. You said there's a time to work. There's also a time to let all that go. Yeah. And be in the moment and enjoy life. Right. And so if that's all you're doing is everything's disciplined and in order, and then you're not having any fun. Yes. What is the point? No. So don't ever forget about we're here once. Yeah. That's good. We got to enjoy life. I think that comes with the whole way through. Not wait till later. It comes with time. You figure this out over time. I think some of our young grinders. I was a young grinder. I literally could go years of focus and actually build something significant, and then look up, and years have passed, and I wasn't looking to guru anybody, influence anybody. I was busy doing it. Yeah. And I had a life break where things happened outside of my control, which kind of changed the way I viewed the world and myself in it. And it slowed me down in a positive way. It made me see things with a little more perspective, friendships, relationships. And it added, I'm going to tell you, had it not occurred, as unfortunate as I felt it was, had it not occurred, I'd probably still be a crazy grinder because I'm wired to grind. I'm wired with discipline. I'm wired to focus. And I think I needed that break, that forced, imposed break to give me these eyes you're talking about, this ability to kind of love the moment you're in, make sure you build in your vacations, make sure you build in time with your loved ones. You got to do it. That's right. And some people need that inflection point where it's like, I had to have it. You would have broke if not. Yeah, I was going to go until there's no more going to do. Yeah. And then you turn around and life's gone. Yeah, and it's like that's exactly right. Where are the people that you fell in love with? They're not around anymore. Exactly. Where are the people that you really enjoyed time with? They're not there. Yeah. And now you're old and you're alone. Like, what was the real point? That's exactly right. So you have to enjoy it along the way. When you are not at work, unplug from it. It's tough. I get it. The mind gets caught on things that are problems, but if you find a way through meditation, through something, whatever works for you to get you out of them. And for me, it happens to be working out, and that's why I bring that up. And me too. It happens to be that I get it. I get in, I get my workout done. I forget about everything else. When I come out of that workout, I don't shift right back into worry mode. Right. Yeah. And so you have to find your thing, and that really is a great lesson for people. I can't believe where we went with this. But, no, I know. It's sometimes it gets riff. You're the type of guy that can really add value to the audience. So I really wanted to extract this type of stuff. Do you think As you think about your life, you've been poor and you've been rich.
Yeah.
You're rich now. You're financially independent now. Is your happiness been consistent, or I want you to talk to the audience. This isn't a therapy session. I'm trying to get the audience some value here.
Yeah.
Is it better to be financially independent, and is it worth it?
All right, this is a great question. I really like this, and it does tie to everything. It does tie to home ownership and independence and all those things and building over time. Look, there is some truth to being wealthy does not ensure your happiness. There's many examples of that. But there is also truth to not having money is a lot more difficult. And so in the years, and we've all experienced this, and guys, it's not like, okay, I didn't have money when I was younger, and then I kept building it over my lifetime. Some people do that. Some people, they go work for a company, and it has a big IPO, and they're done. Like, that's it. They won. They won the game.
Yeah,
like
they got lucky.
You can't be envious of those people. You can't think that should have been you.
No.
That's their life. It's not yours. It's not the same for everybody. And there have been times where, like in the crash of 2000, I lost everything. I barely hung on to a couple properties I had. Everything else was gone.
Yeah.
My mom had stage 4 cancer. I had to go through that at the same time. Like, God basically said,
Slow
it's your
down.
time to figure things out.
Reset.
I took the next decade, and I spent so much time with my kids and
Yeah.
their formative years and all that. So everybody's got their own cadence to life. But what you have to do is concentrate on why you're here. And not everybody is going to be that wealthy. Not everybody is going to have yachts and all these other things. And that's not going to ensure your happiness. Do what makes you happy. Follow your heart. Follow your path. And don't look at your neighbor. Don't look at your friend. Don't look at if you can do that. So that's the other element of an attribute to somebody who is not just wealthy by the means of money.
Yeah, successful.
But successful in life.
Fulfilled.
It's being fulfilled.
Yeah.
And so in answer to your question, I have pretty much always felt that way.
Yeah.
And whether I had,
Yeah.
whether things were good or bad. And I've got different things going on right now that are very, very difficult. Lots of pressure.
Yeah.
Things I can't control. Investments I've put millions in that are falling apart.
Yeah.
Like, all that stuff exists. I'm not up here saying, hey, my life is perfect.
Yeah.
But it's compartmentalized.
Yeah, right.
It's compartmentalized.
And you've spent a life training to manage it. So
Yeah.
if someone else was handling your plate, they probably couldn't.
Correct.
You're trained through a lifetime of discipline and focus to manage the plate you've got.
I think you're right.
And you wouldn't swap it out. This is
your
my
life.
Yeah, that's right. That's right.
You can't swap it out.
Yeah, no.
So I think about it.
Exactly. A lot of people do that, though. A lot of people think,
know
I
they
wish I
do.
had his life,
I know.
or whatever.
Well, maybe this touches one person that goes, you know what? I got to stop thinking like that.
Yeah. Yeah, I remember, I'll just share this, then we can kind of get wrapped up here. But I remember the question I just posed to you. You've been poor and you've been wealthy. Are you happier now? I can honestly say, because I recall I had enough self-awareness as a young man to kind of know and be aware of what was going on around me, right? I remember the climb when wealth and success was not present yet, but I was in it.
Yeah.
And I was creating it, and I was thinking about it, and I was on a whiteboard, and I was running a balance sheet, and I was keeping up with expenses, a line item, detailed expenses, life expenses, groceries, credit card, the things you got to do to run your life. I remember being happy, like being really happy, and I think the happiness comes from the grind. I think the happiness comes from the purpose, the organized, purposeful driving. And if you could just get your life organized, purposeful, meaningful, and get yourself a track to run on, happiness at that moment becomes constant. And if you'll just stay with it, the wealth will fall in behind you. Whatever you've chosen your line of work. I mean, you may have chosen a field that doesn't pay so well. I don't know what business plan you're following, but if you did choose a plan that's fruitful financially, the money will fall in behind, but the happiness level won't change, because the happiness is tied to the grind.
Yes.
It's not tied to the arrival. It's not tied to I got 16 million in the bank. It's not tied to that. It's tied to the fact that you found your way to the tracks. You've got a purposeful way of living. You're busy managing that purpose, and you are on your way. The happiness begins to mark time then. And it will be constant for you. You'll have different fruits of that happiness. You'll have different rewards of that happiness. You'll have different things to spend money on. But the happiness itself, which you seek, begins with a purposeful, constructed plan that you're in charge of.
That is so well said. And that is a piece of you. And
Yeah.
not everybody is like that. I am exactly like that. Happiness comes out of the grind, trying to achieve something, getting there, navigating the way there. Like, I
Mapping
enjoy
it
that.
out.
I enjoy
Yeah, me
that
too.
process.
Me too.
But it's not necessarily of reaching it. So there have
No,
been many
no.
businesses that I have really enjoyed the process and
Yeah.
enjoyed the people around me and the grind and all that
Yes.
stuff. And we never actually even get there.
Yeah, right. Well, I may change the plan.
We might have to divert and abandon it.
I may completely scratch this one off,
Yeah.
get on a new set of tracks, run a new plan, but it's the process.
It's evidenced by what you do now.
Yeah,
right? You
right.
don't have to work right now.
No,
But you love building.
I fucking love it.
Yeah.
I love it. I love the impact I feel I make
Yep.
with the people I get a chance to influence.
That's right.
That's what
we
I
might
love.
have to work together.
We might.
Yeah, we might.
Brother, thanks so much for doing this with me today. It's been an honor. Thank you.
My honor.
All right. Well, I hope you really enjoyed that today. Again, I knew that this would resonate with some of you, and having that mindset piece of it at the end, I think could really have impact. So if you enjoyed what you saw or what you listened to, please like, follow, share, subscribe. Doing all those things really do help, and we appreciate you. We'll see you next week on The Blueprint.